Hi everyone, my name is Mark Quinn. I'm a tax advisor and chartered financial planner based in Portugal, and I help expats relocate here from a tax and financial perspective. In this video, I'm going to look at how best to structure your affairs in order to make Portugal your very own tax haven. Now, just a caveat before I start, none of this is intended to be financial advice. Obviously, everybody's situation and objectives differ, so please always take personalised advice before you take any action. So without planning, Portugal and many other countries in fact can be quite expensive places to live from a tax point of view. But with the correct planning in place prior to arrival in Portugal and also during your stay here, you can make Portugal a very tax effective place to live, and in fact some of our clients are actually paying zero tax. The starting point and the framework for tax and financial planning for many is the non-habitual residence regime, otherwise known as NHR. And NHR is a 10-year tax incentivised scheme for new residents of the country. And new means that you haven't been a tax resident here in the last 5 years. That's the main qualifying condition. As long as you tick that box, you're effectively into the programme. And then you've got 10 years where you can potentially live at zero tax or possibly low tax rates. Besides NHR, there are a number of other positives going for life in Portugal from a tax and financial perspective. The first one is that there's no inheritance tax here. So inheritance tax was abolished in 2003. There is a form of succession tax, which is basically a stamp duty charge, but it's very limited in its application because it doesn't apply to direct line descendants. So if you're leaving assets to your children, grandchildren, etc., it's not going to apply. It doesn't apply if you're leaving assets to each other between a married couple or civil partnership. And also it's a territorial tax, so it only ever applies to Portuguese assets. Any assets outside of Portugal are not subject to that stamp duty charge. There's also no wealth tax here in Portugal, unlike say Spain. And the Portugal tax system is very simple. So again, if we compare it with Spain, the Portuguese tax system is a uniform system, so it doesn't matter where in the country you live, you're going to be subject to the same tax regimes and benefits. Compare that with Spain, which has these different autonomous regions that have different tax rates in addition to the nationwide taxes. So within NHR, how do you structure your affairs to be tax-free? Well, there are a number of areas which are very black and white and clearly tax-free. The first is the simplest, which is dividends. So dividends from shares in companies are tax-free under NHR. If, for example, you have a UK company, the UK tax authorities will not apply tax at source. Portugal won't apply tax, so you're getting it tax-free at both ends. It's also possible to structure certain business sales free of tax. Now, this is very specific to each person's situation, but in some cases we've managed to secure a completely tax-free sale, and in fact in one situation we've been able to create accounting losses to carry forward to offset against future gains in Portugal. Pension income. So for those of you fortunate enough to have qualified for NHR pre-April 2020, again this is a completely tax-free source of income. The rules were changed in April 2020, meaning that from that point onwards pension income is taxed at a flat rate of 10%, which is still good if you compare it with the 20% starting rate band in the UK, going up as high as 45%. There's also no tax on property sales here in Portugal, and by that I mean non-Portuguese property. So for example, if you're selling a UK property, there's no tax here if you're selling it as a non-habitual resident. Also, even though if we take the example of a UK property, you'll always be subject to tax in the UK. As a non-UK tax resident, so if you become a tax resident here under NHR, there's a concession that exists in UK legislation, meaning that you're only subject to tax on any gains since April 2015. So any increase in value before that is effectively washed out. So for example, if you bought a property in 2000, any appreciation in that property value to 2015 is ignored, and then you simply take the April 2015 market value at the time as your effective cost of buying the property, which in many cases we've seen has washed out considerable gains and resulted in obviously considerable tax savings as well. It's possible to engineer tax-free withdrawals from trusts in certain situations, and there is also a preferential regime applying to employment income. Now, for employment and self-employment income, the general position is that you're treated as a standard Portuguese taxpayer. So I myself have NHR, but because I live and work and perform my work duties in Portuguese territory, I pay tax as a standard Portuguese taxpayer. However, if you qualify for what's called a high valued activity, you can qualify for a flat rate of 20%, which is really attractive when you consider that standard tax rates here go as high as 48%, and similarly in the UK go as high as 45%. If you do find these videos useful, I'd be grateful if you could like and subscribe to the channel, and also put some suggestions in the comments as to what you'd like me to include in future videos, because the videos are there for you. I want them to be useful and I want to add value to you. Thanks. If you do have NHR already, just be cognizant of the fact that it's a limited 10-year window, and speaking personally, I'm in the final year of my NHR. It's flown. So just be cognizant of the fact that when that time period comes to an end, the tax treatment does change. So again, take advice early in your membership of the scheme, and make sure you're doing the planning to ensure that you're tax efficient even beyond the end of the 10-year point. For those without NHR, Portugal can still actually be a really tax effective place to live, but it's always about getting the right advice and structuring your affairs to take advantage of the different exemptions and sync with the Portuguese tax system. So we've covered the things that do work. So we've talked about dividends being tax-free, potentially getting money out of trust tax-free, pre-2020 pension income being tax-free, the ability to sell properties free of tax here. So now let's look at what does not work. So one of the key areas for us in helping our clients is a lot of them have share portfolios, investment portfolios, that they can be held directly or through individual savings accounts, for example, in the UK. And whilst they're tax efficient in the UK, they're looked through from a Portuguese standpoint. So the Portuguese tax authorities would look through the ISA wrapper and tax the underlying capital gains and any income coming from it. And it's the same if you hold shares, investment funds outside of wrapper. Again, they're going to be subject to 28% ongoing capital gains tax. And also what's not very well known is that even under NHR, if you have income from a collective investment scheme, so if you have ETFs or investment funds and they're producing a dividend or interest payment, they're going to be subject to 28% investment income tax here in Portugal. Again, even if you're an NHR. There are solutions to this, and what we generally do for our clients is we try to wrap their investment portfolios in a tax efficient structure, so you don't have that ongoing 28% capital gains tax hit, and also the same on any income payments. The other issue which I've spoken about already that doesn't work is employment income. As I say, if you're performing the work and your duties from inside of Portugal, you're generally going to pay tax here unless you qualify for a high value activity definition. A route around this that some people pursue is that, if possible, instead of structuring your remuneration in the form of a salary, if you're taking it from a company, if you're taking it in the form of a dividend payment, then, as we've spoken about earlier, dividend payments would be tax-free. And another positive is that dividend payments are not subject to social security contributions, whereas a salary would incur social security, again in Portugal. So with that in mind, one of the key things that is important is, if possible, if you've not moved here already, and if you're still a tax resident elsewhere, look at what you can be doing in your home country prior to arrival in Portugal. So we've touched on this ISA example. If you have ISAs in the UK, then some people choose to surrender their ISAs whilst they're still in the UK because they can do so free of tax. If, on the other hand, you waited until you become a Portuguese resident to do that, you're going to pay a 28% tax charge to wind that ISA portfolio up. Now, this isn't a black and white issue. Some advisors will say you have to surrender your ISAs before you leave the UK. You don't actually need to do that, and sometimes it's actually appropriate for you to retain those ISAs. So if, for example, moving to Portugal is just a short-term move and you're going to return to the UK within a relatively short time frame, it probably makes sense to actually keep the ISAs in place. In that case, what you might want to do is what we call rebase. So imagine if you had, if you put 100,000 into ISAs over the last 10 years, and it's now worth 200,000. What you could do is, before you leave the UK, is you could sell and rebuy within the ISA, so there's no tax charge. But by doing so, you're raising your cost from 100,000 up to 200,000. Therefore, if you ever did need to take money from your ISAs in future as a Portuguese tax resident, a lot of that gain would have been washed out in the rebasing process. With tax and financial planning, part of our job is to think creatively, and sometimes the obvious solution isn't necessarily the most appropriate. So, for example, we've helped a client recently who wanted to extract a large amount of money from his pension scheme, and he engaged us to organise it under NHR and take advantage of the 10% flat rate of tax. What we managed to do for him was actually create a lower tax charge of just under 3% by doing a bit of creative financial planning. But the important point there is that he took advice early, so he was able to extract that in the UK at the less than 3% tax rate prior to becoming a Portuguese tax resident. So again, always seek advice before you take any action. So in summary, the benefits of NHR are there to be enjoyed, but they don't apply automatically. You really need to take advice. You need to take advice as early as possible, and you need to structure your affairs accordingly. I hope this video has helped. If you have any questions, please reach out to me direct, and I look forward to seeing you soon. Thanks.